Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have George Bragues. He is Assistant Vice Provost and Head of the Business Program at the University of Guelph, Humber in Toronto, Canada. He teaches investment finance and also has references to the Austrian School of Economics in his classes. Welcome, George.
Great to be here. Thank you for having me.
Great, and just thought we'd begin with the book that you have. It's called Money, Markets, and Democracy, Politically Skewed Financial Markets and How to Fix Them. Can you give us an elaboration on what the basic messages are, the themes of your book?
Sure. I think the key thing that I want to get across in my book is the importance of politics for understanding the financial markets. And this is something that gets often missed in your typical courses that are taught at the MBA and also at the undergraduate level. When a student takes a course in investment finance or financial economics, they don't get exposed a lot to the political factors that drive prices, that drive trends, that drive decisions on monetary policy and interest rates. And I think, as was made abundantly clear with the 2008 financial crisis, although one could have seen evidence of the role of politics in finance earlier than that, but it became much more obvious after 2008. This is definitely a gap in the way financial markets are taught to students and the way they're discussed by economists in general. So the book is designed to address the flaw, the defect that the economics profession tends to be the only one that studies the financial markets. They dominate it. They practically hold the monopoly in it. And I think other disciplines, specifically politics, need to be part of the mix. Now, as the title suggests, it's not just politics per se or politics in general that needs to be considered, but the regime. The regime is defined as the fundamental rules of the political game. This is actually a term that comes from the ancient Greek philosopher Aristotle. He wrote a book still very well known, still discussed among political philosophers, called The Politics. And he distinguished regimes into three types, and he distinguished it by who rules. If you want to know what a political system is like, you ask yourself, who's running the show? Who's making the decisions? And three basic different types of regimes that are possible. Ruled by the one, which we would call autocracy. Sometimes we call it monarchy or a dictatorship. There's ruled by the few, which we may call aristocracy, or sometimes referred to as oligarchy. And then there's rule by the many, and democracy would be the example of that. And so financial markets around the world today, with only a few exceptions, China primarily among them, most of the major financial markets today are operating within democratic political contexts. And the argument I make in the book is that democracy, because of the political incentives that it imposes on politicians, because of the values, the types of norms, the morality that democracy has, and that these two factors, the value system and the political incentives, what politicians need to do to get elected in a democracy, that these fundamentally structure the nature of the financial markets. They don't do it necessarily on a daily basis. You can't day trade on this information or even swing trade on this information, but it definitely will illuminate anybody who's involved in investing in the financial markets to help them better understand the forces that drive prices over the long haul. And so my thesis is that democracy, while probably the best, not probably, but definitely the best political system relative to the alternatives, despite its being the best of the available alternatives, It does create problems in the financial markets. It does distort the ability of the financial markets to do social good. So a lot of the problems that we have are because of the fact that that the markets are operating in a democracy.
And how does that happen? Like, how does democracy distort the financial markets? Can you give some specific examples?
Yeah, sure. The big example that I discuss in the book is the money supply, the main argument that I make is that democracies tend to oversupply money into the economy, and that has an impact on the financial system. I distinguish two factors that drive democracies' overproduction of money, this excess liquidity. One factor is this class conflict between taxpayers and tax consumers. And this notion of a class conflict between taxpayers and tax consumers is a notion within Austrian economics, and it is meant to replace the Marxist view that the fundamental class divide in a society is between the bourgeoisie, the capitalists, those who own property, and then the labor, the working class, those who don't own property. The Austrian view is that the main class division is between those who on net pay more taxes than they receive in services from the government. So that this group would be the taxpayers. And then the tax consumers are those who on net receive more from the government than they pay. And in terms of what a tax consumer can receive, this can range to anything from unemployment, insurance payments, social assistance payments, favors provided by the government in terms of inhibiting competitors in your industry. So the argument is that in a democracy, if a politician wants to get elected, the name of the game is to get 50% plus one. And given that the distribution of income in modern commercial societies tends to be such that there's a few rich, the wealthy tend to be a small segment of the population, and then the middle class and the lower classes tend to be the majority, that the best way to get elected is to offer mostly the middle class in it, because that's really where the votes are, all sorts of public goods in terms of social programs and so forth, and then have those financed by the well-to-do who would function as the tax-paying class, and that way you're going to get your majority to get elected. So all politicians, whether of the left or the right, both sides of the political spectrum do this. Perhaps the left with a bit more conviction guiding their efforts, but both on both sides, both ends of the political spectrum, this happens, and so politicians engage in this bidding war every time election time comes, trying to offer the majority all these goodies, and then with the idea that they don't ultimately have to pay for it, someone else will. What ends up happening, I argue in the book, is that after a while of this bidding war among politicians to offer more and more public goods, someone has to finance this. Eventually, you run out of taxpayers, or you run into taxpayer resistance. The people who are paying the piper say no mas, I can't do any more. And at that point, politicians then resort to the bond market. The bond market has proven historically quite eager to lend funds to the government. Government bonds are a very attractive investment for a lot of folks because of the safety. This is money that's backed up by the coercive power of the state, unlike corporate bonds, which are not. Corporate bonds only pay ultimately if the corporation is successful at attracting people to voluntarily buy their goods and services. And so I argue in the book that we now have a kind of financial market government complex, or more a bond market government complex, where the bond market has emerged as a kind of handmaiden to the welfare state, to this growing to this growth of government, so that'd be one way. And then at a certain point, even the bond market will say, okay, no mas, we can't lend more. And at that point, politicians will then appeal to the money press, and they will enlist the central bank to print money, essentially, although it's more complicated in terms of how liquidity is injected into the economy. It's a bit more complicated than that, but that's basically what happens. So essentially, democracy leads to fiscal profligacy. Too much is spent relative to the revenues that politicians are willing to collect from people. They then have to go to the bond market, so public debt rises, and then they to increase their options of financing this deficit that is inherent to democracy, it appears. They then require control of the monetary supply. And so my argument in the book is that the gold standard, which existed for a good part of the 20th century in one form or another, but which ultimately ended in the early 1970s, or August 1971, if we want to get exact, that was in a way written in the DNA of democracy, that democracy ultimately is in tension with a monetary constraint like the gold standard. And so that's one of the ways I make this argument that democracies do damage to the financial markets.
Yeah, because it sounds like the end game would be either a no bid situation in the bond market, maybe,
yeah,
or the other, as you mentioned, they could go to the printing press. So the other end game is the loss of purchasing power in the currency.
Right.
Yeah. So either way, I guess that's likely to be the only way to stop this sort of political or the politicians' continuous spending on profligate spending, basically.
Yeah, either the bond market has to say no.
Yeah.
And historically, as I mentioned before, they're not very good at saying that. In the book, I discussed the historical record of the bond market's ability to keep governments to account. I remember in the past, I think he's still around, Ed Yardeni coined this term, the bond vigilante, which was a popular term in the 1990s. The bond vigilante is this creature that supposedly is watching over governments, closely scrutinizing their budgets, and if they see any sign that they're letting public debt out of control, these bond vigilantes then start selling off the bonds of the country that is engaging in this poor fiscal policy. The record is, especially with developed economies, is that that bond markets only react to excessive public debt very late in the game, when it's become quite obvious, and bond traders seem to be very eager to provide money to governments who are spending above their means, while the debt is building up, and only when a certain threshold is hit, and no one really knows. It's really hard to define that threshold. Mm-hmm. There was Kenneth Rogoff wrote a book a few years ago where he went through the history of it and said, well, if it's a developing country, it appears to be 60% of GDP. If public debt goes above that, that's when the bond vigilantes come out. And then for developed countries, they tend to have more tolerance. But even that threshold doesn't seem to have held, because we now have countries, Japan principally among them, that are well above 100% public debt of GDP, and there's no sign that the bond markets are are growing less willing to finance their debts. So yeah, the bond market would have to have a shift in how they approach their investments into bonds, and government bonds, that is. And then the other constraint would be the gold standard. But as I talk about in the book, I don't totally foreclose the possibility of a return to the gold standard. I agree that indeed that we should try to do as much as possible to bring that back. But Democratic politicians, they don't want to have the constraints posed by a gold standard because it makes their lives difficult.
Yeah.
It means that they have to, say no to people. It means that they can't win elections by simply promising all sorts of goodies. And so it's no surprise to me that the gold standard ultimately disappeared as democracy progressed.
Yeah, and you've provided generously a number of slides which we'll make available on the website in terms of the basic messages of your book, including one slide with a quote from James Grant, editor of Grant's Interest Rate Observer, where he highlights that you not only diagnose the problem, but also prescribe the solution to the problem. So that's, as you mentioned, on the gold standard. So what you're saying, though, is while not likely to happen or not likely to come about, you do identify the solution. And so what is more likely the end game, no bid in the bond market or just a gradual loss of purchasing power in the currency?
I would probably say the latter, especially with over the next 20, 30 years or so, you have an aging demographic, a greater proportion of people who are older, and they will seek safety. And I think that keeps up the bid in the bond market. So I would say, very slow decrease in purchasing power. And the thing is, too, is that now prior to 1945, inflation was practically non-existent. You would have inflation only in certain periods, usually after a war, after some sort of crisis, when the government was compelled to appeal to the monetary press to finance conflict. And so if you look at the data, say from early 19th century to 1945, I think in Britain, for example, I'm just going off memory here, there's really no change in purchasing power. A pound is worth around the same in the early 19th century as it was, say, going into the early 20th century. But that's all changed since 1945. We now live with a situation which we think is normal, but which, from a grander scheme of things, is not. And so people in democracy seem to be willing to live with an inflation rate of around 2% a year. And I think the governments are going to try to just keep that going, and if necessary, perhaps tolerate a somewhat higher rate, 3, 4, maybe 5. I know some economists have talked about that, about tolerating a different target range for the inflation rate. I think all the incentives are for politicians to continue to take advantage of the bond market's generosity, if we want to use that term, and try to finance this via the inflation tax at the highest level of tax that is feasible without incurring significant public protest.
Yeah, I think we've seen figures of if you have inflation at about 4% a year for 10 years, it can reduce the burden of debt by 1/2, something like that.
Yes, certainly. Yeah. And if you look at history, when we look at how the debt after World War II was dealt with, it was a form of financial repression that took place where the inflation rate was held higher than the rates that most people would be able to gain on deposit. And so that was I think they'll probably appeal to that strategy again.
Yeah, yeah, likely, very likely. Just switching gears slightly, we've talked about the Austrian School of Economics, um, and you've also provided a set of slides on the investment potential of Austrian economics in investing. And just wondering if you can give some highlights of those slides, and also how you see Austrian School of Economics compared to the Keynesian School of Economics.
Sure. So in terms of Austrian investing, I think it's a promising approach. In order to succeed in investing, you do have to have an approach that is different from other people, because if you're just doing what everybody else does, you're just going to get at best the average rate of return. You'll get the same rate of return that you might say with a passive investing vehicle like an index fund, minus the cost of running your investments, the commissions and so on. Because most people in the financial markets are essentially Keynesians, they may not be conscious fully of their being beholden to Keynesian principles, but anybody who follows the markets on a regular basis, specifically on issues of how the Federal Reserve or the ECB is expected to react to certain data points, it's clear that when you see a lot of these analysts get quoted in the Wall Street Journal and the Globe and Mail and so on, that they effectively are operating with a Keynesian worldview. So in terms of having a unique point of view that can offer above average returns, I think Austrian economics offers something that is certainly worth looking at. In terms of what it boils down to, I'm the first one to admit that there's no set Austrian approach. You can have 5 Austrians in a room and they'll have 5 different approaches, although they'll come from a common base. That common base being the commitment to certain core Austrian economic principles. And I'd say the 2 biggest ones that are relevant in terms of investing are the rejection of the efficient markets hypothesis, which is very common in the academic treatment of finance, even though it's losing some support to another field called behavioral finance, which argues that psychology needs to be considered in understanding how markets move. But efficient markets hypothesis still looms large, especially in academia, and it argues that at any point in time, prices reflect all available information, so that everything that is known or can be known is already in the price. So there's no point in doing any type of analysis to try to beat the market if you believe in this theory, because everybody else has already looked at the financial statements, they've already considered the company's strategy, they've already looked at the technicals and the moving averages and the trend lines and all that. It's already in the price. The Austrian view rejects EMH, and it's because of its theory of entrepreneurship. Austrians are very big on the notion that what drives economic activity, and specifically economic growth, is the activity of entrepreneurs. And what entrepreneurs do is they find arbitrage opportunities. They find situations where other firms, other managers they find profit potential that other people aren't seeing, so we can transplant the entrepreneurial function to the financial markets and say that there are similar arbitrage opportunities, that other people aren't seeing, that with watchful eye, good analysis, with some work can be grasped. So that's point number 1 that differentiates the Austrian approach from the more mainstream approaches that are taught in academia. The second component that differentiates the Austrian approach from the academic, and certainly the Keynesian approach, which tends to be, like I said, dominant among financial market practitioners, is is the notion of it's called Austrian business cycle theory, ABCT as it is known among aficionados. And this is the argument that central banks, through their policies in terms of money supply and interest rates, artificially induce booms and busts. So booms and busts are not, on the Austrian view, simply sort of random events, sort of facts of life of capitalism, or caused, as some of the old Keynesians would argue, by a lack of aggregate demand. They would argue that the reason why we have bull markets and bear markets is in large part because of the actions of central banks. And they would argue that central banks have a tendency to run overly loose monetary policies because all the political incentives are there for that. And that's my book reinforces that. And so what happens is that they tend to set the interest rate below what's called the natural rate. The natural rate would be the rate that the market would set if the interest rate market were free, which it is not when you have a big central bank regularly intervening in the money markets. And the argument is that when interest rates go below the natural rate, whenever they're below what the market would dictate, then it gives false signals to investors that future goods with long-term potential, real estate would be the classic example here, but also certainly technology stocks or something where, electrical cars or something like that, anything where the payoff is way out in the future, those kinds of companies that engage in those products, they tend to get overbid. Too much investment tends to flow there. And then the Austrian view argues that this will initially sustain a boom, especially in these areas of the economy, but that at some point, one of two things or a combination of the two happens. Either people realize that these investments are not going to work out, that the demand is not going to be there, that these future goods that everybody's producing for, there's not going to be sufficient demand for them, and so you get a shakeout in that industry, or two, the central bank decides to tighten monetary policies because they could sense that things are getting a little too frothy, or a combination of the two, and then you have the bust, and then the market goes down, and then the idea is that it's the central bank will come in now while the bust is taking place, aggressively lower interest rates to try to revive things, and then the whole cycle starts over and over again. And so that's probably the most important component of the Austrian approach to investing, is this acknowledgement that central banks are the ones who are ultimately behind the longer term ups and downs of the market.
And in terms of other indicators or other aspects of the Austrian school that could help in investing, you mentioned a few here, like the Q ratio from Mark Spitznagel.
Yep. So because the Austrian view recognizes that there are going to be different phases of the stock market where things either get overvalued or undervalued, then the question arises: how do you recognize when we're in a phase where things are overvalued and where things are undervalued? So one approach that's been put forward is by Spitznagel, as you point out. I believe his book's called The Tao of Investing. I hope I got that correct. And he argues that we look at the Q ratio. The Q ratio, I think, if I remember correctly, goes back to James Tobin, actually a Keynesian economist. And Tobin's Q ratio is based on the numerator being the market value of companies, so sort of roughly stock market capitalization, divided by their their real asset value, and that's measured in the Q ratio by the replacement costs of the assets of the firm. So basically, you're looking at the Q ratio measures how much would it cost to buy all the companies on, say, the S&P 500 index, and you take that number and you divide it by what would it cost me if I were to try to replace all the assets, going out into the real asset market and try to replace all the assets that are currently on the balance sheets of S&P 500 companies. And in theory, it should be 1. That is to say that the market should be valuing the assets at their replacement value. That way you avoid an arbitrage opportunity, because in theory, if the net asset value is higher than the replacement cost, the market value is higher than the replacement cost, then you can sell stocks and buy the assets. And then conversely, if the market value is below the asset value, you can buy shares and then sell the assets. But historically, that ratio has been around 0.7, and so we Spitznagel suggests that we use that as the anchor. And so if you're above 0.7, that is suggestive of an overvalued market, and if you're under 0.7, that would suggest an undervalued market. Currently, I looked at that ratio today. We're about 1.07. That's not the highest that it's been at historically. It has been as high as 1.78 in the early 2000s, at the height of the dot-com boom. But currently at the 1.07 level, it's at similar highs at other turning points. If we just take the early 2000s out of the picture. So if you look at early 70s was another high. Also, another high would have been just before the 1929. So if you look at the Q ratio, that is suggested that we may be at a key inflection point here. That is my only concern with the Q ratio. Just like I would have any concern with any sort of other fundamental type of metric, whether it's P ratio or price to sales ratio or PEG ratio, is that they can show for a long time that an asset is overvalued or undervalued, and if you were to take a position in accordance with that signal, it could take a long time for it to actually go in the predicted direction. So it's a notorious problem with these kinds of signals. So I suggest actually that Austrians can apply technical analysis, and the approach here would be you use some sort of long-term moving average, or this would be just one technique among several that one could use to gauge the long-term trend, and you take advantage of the trend, and you wait until the trend is broken. So if you're using, say, a 10-month moving average, then you wait for the index, let's say it's the S&P 500 index, to close below that average at the end of the month, and that would be your signal that it's a frothy market. But now other people are recognizing it. It's just not me with my Austrian analysis. And now that the market seems to be coming to realize what's going on, I will now get out. And conversely, when things are looking undervalued, so an Austrian analysis could tell you that things are looking undervalued now. The bust has perhaps gotten a little too far. People have gotten a little too fearful, a little too anxious, and but you wouldn't immediately go in. You would wait until the market went above the 10-month moving average. So this I would argue this would avoids the problem of using something like the Q ratio or some sort of P ratio. I mean, there's also you could also use a 10-year P ratio, which is like Robert Shiller's has that indicator. that you allow the market to tell you when the trend is over, when the frothiness is really done. So I've done some back testing on it. It seems to work fairly well, and there's also a number of people out there that follow this method. But most people who follow the method just look at the moving average. They don't have a sense of what they don't come to it with an Austrian understanding of where the market is, sort of temperamentally, as it were, if it's overvalued or undervalued. They're just looking at pure trend. So the market here is a combination of the fundamental and the technical. With the Austrian provides you with the fundamental, but then the technical provides you with the entry and exit signals.
Very interesting. And another aspect of Austrian school would be a focus on stores of value. So you mentioned you have a slide here about gold. If you want to talk to that a bit in terms of
Sure.
how that can play into a store of value.
Yeah. So one thing that Austrians can sometimes fall into the trap of is becoming excessively pessimistic. There are good reasons to be excessively pessimistic when one considers the fiscal state of our governments and what central banks have been doing to finance that fiscal profligacy. But the reality is that markets seem to do a different thing that what some Austrians who are really very negative would predict. And so and Spitznagel makes this point in his book as well, that Austrians need to be careful about getting a little too pessimistic, and that might translate into like going into 100% gold. So I would not be in favor of that, going to a 100% gold position. But I do think that it is a good store of value, to use your phrase, and that at least some portion of one's portfolio should be in gold. Several reasons. We really don't know how this whole thing is going to play out in terms of these highly indebted states and central bank excess liquidity that's been provided. So we're not sure how that's going to play out. It could play out very ugly. The Austrian, my Austrian friends who are among those who are very negative, they may turn out to be correct, and you want to have a position in your portfolio where you profit from that, or at least you protect yourself from that. If, as I expect, we're going to have this continuous, slow reduction in purchasing power, whether it's 2% or 3% or 4%, whatever it is, that does have a long-term impact. That does compound. And gold has proven able, when looked at it from a longer-term trajectory, to preserve your purchasing power against that. So you look at, I just did this calculation today. It's something we're going to have to update in the stock market and in the PowerPoint slides that I provide to you. But if you look at the returns of the S&P 500 index, total return, assuming you reinvest all your dividends, from 1971 when the gold standard ended, from August 1971 to be more exact, and you compare it to gold, I think there's only about my number is, so if you had put your money in the S&P 500 and reinvested your funds when the gold standard was abandoned in August 1971, you would have made about 10.38% per year, so just over 10%. If you had just put it in gold, you'd be at 7.58. So you're only looking at about just under 3% differential, and that's that's not bad. Gold is you're not risking your money in businesses. You're not really when you invest in gold, you really can't expect that you're going to earn a risk premium that a firm would typically be expected to earn for assuming risk in the marketplace and offering goods and services. So to only be around 3% behind, and this is from the current date where gold's relatively low. It's well off its highs from 2011, and the S&P 500 is at near its all-time highs. So right now, this calculation is very much favoring the S&P 500. But over time, gold doesn't do too badly, even though things right now might not look that great in terms of its performance vis-a-vis the S&P 500 index. But looked at it from a longer term, it does trail. But you'd expect that because the S&P 500 is a different kind of investment. You're investing in companies, and there's extra risk there. So you should be compensated for that. So from a crisis protection point of view, and also from a protection from this continuous reduction in purchasing power, I think that argues for some proportion of your portfolio being in gold.
Excellent comments. Yeah, excellent views. I guess just to close out, if we take the Austrian School of Economics and the basic messages and themes of your book on money markets and democracy, how do you see the situation today in terms of perhaps the millennial generation, where they're going, where they're leading politics with respect to economics, finance? What are the millennial views and perspectives on the economy and the financial markets currently? How are these views being formed by political, financial, and economic trends?
Sure. So the millennials. So that's a pretty slippery term to define.
Okay.
We'll go with 18 to 29-year-olds.
Okay.
And 18. And so interesting. I mean, this has been a talking point for the last year or so, and it certainly became a major point of discussion with the success of the Bernie Sanders campaign. I mean, they didn't win the nomination. He didn't win that, but he certainly put up quite a battle to Hillary Clinton. So there was a survey done by Harvard University. It came out just over a year ago, which showed that millennials in the United States, so these are young people from 18 to 29, that for the first time since they've been doing these surveys, that a majority of them no longer supported capitalism. The number was actually 51% no longer supported capitalism. 42% still supported capitalism. I'm not sure exactly what the remainder. I'm assuming that they were undecided. And certainly, with Bernie Sanders, who is a self-professed socialist or a social democrat or democratic socialist, as he put it, certainly this played out politically. This is a concern, although we shouldn't make too much of it, but it is definitely a concern. I think the reason why we should not overplay it is that traditionally young people have veered more towards the left. And so if you look at voting patterns, for example, I was looking this up today, and for example, in Britain, the likelihood of somebody who's young voting conservative. Now, I'm not saying the Conservative Party in Britain are, perfect pro-capitalist, perfect pro-markets, but they're more likely to be pro-market than the Labour Party on the left of the political spectrum in Britain. Going back to the end of World War II, younger people much more likely to vote for Labour or for some other party on the left than for the Conservative Party. And then as people get older, they tend to veer conservative. And so there's the saying that I hope I got it right, that if you're not liberal before, meaning left, when you're under 30, you have no heart. But if you're still liberal after you're 30, you have no head.
And the king of Sweden, I think, something like that, right? It was.
Yeah. So it's a nice, and it nicely captures out how age affects political and ideological affiliation. So that I think when we consider that I think means that we should moderate some of our concern, but it is a concern, and so the question arises, why? And I think there are a number of reasons. One is they're just young. They're more moved by their passions. Morality and is very much implicated with their passions or moral sensibilities, and young people tend to be quite idealistic. And when you look at capitalism, it, at least on the face of it, I wouldn't say this is the definitive interpretation of it. But on the face of it, it looks like it's driven by selfishness, by self-interest, and if you're idealistic, that's not a good motive to have. That's not a good motive for society to be energized by. And so that, I think, is a factor that leads the young away from capitalism. Another factor is just the educational system. Despite all the work that the Milton Friedmans and the Hayeks and the Mises of the world, which is great work, great arguments, great books, they still all that effort still hasn't made its way into the educational system where young minds are formed. Certainly has not made its way into the university system where supporters of free market capitalism are a distinct minority. So I think that's part of it. And I think, too, there are certain factors of the way the human mind works that works against the proponents of capitalism. It makes it more difficult for the pro-capitalist side to make its argument. And the human mind is structured in such a way that we tend to favor the concrete over the distant, the specific over the vague. And whenever you make a case for capitalism, you have to make arguments that tend to be abstract, that tend to emphasize longer-term benefits, things that are not immediately evident. That's a problem that the opposite side, the side that views government as having a greater role in the economy, they don't have that. They don't have that problem. My favorite example is with let's say you think there's a problem with wages, that some people don't make enough money. The free marketeer could tell you the story. Well, if you let wages be free, eventually people will acquire skills. They'll have an incentive to do so. They'll invest in education or work harder to get promoted, and eventually they'll get up. They'll get up the income scale. That's sort of a more longer term view, and it's it can be mentally grasped, but it's a lot more clear, a lot more vivid if you could just say when you tell people, well, we could just pass a law, and we could set a minimum wage at X level where we think people are going to be less poor, and there's the end of the story. So it's an easier story that the other side has to tell, and I think that plays into this situation with respect to the millennials.
Wow, great insight and observations, George. George's book is Money, Markets, and Democracy, Politically Skewed Financial Markets, and How to Fix Them. How can our listeners learn more about your work, George?
They can look me up on scholargoogle.com. I do have all my list of articles there. My books can certainly be you can find them on Amazon, and also people can just reach out to me via email. I'm certainly happy to make my contact information available, and if anybody has an article out there of mine that they would like to read and they can't get, I could certainly see what I can do to get it in their hands.
Great. Thank you very much, George, for coming on the program show. We'll have your slides available on the website.
Okay. Thank you for having me.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.